Today, I'm here with Rohan, Peter, and Rob from etcTax, and we're going to be talking all things tax related with property. So, hello, boys.
Hi, everybody.
Hello. I can't wait to get started. So without further ado, I will shut up waffling and introduce Peter, who is going to share a little bit about etcTax and the way etcTax works before we get on to the main element. So good morning, Peter. Over to you.
Simon, thank you, and good morning to everybody. I'm just going to share my screen. Hopefully everybody can see that. Thanks again. Welcome. My name is Peter Loughlin. I'm Business Development Manager at etcTax. I'm trying to get my slides to move. There we go. We're running. I want to start with a brief introduction to ETC, just so you kind of know who we are. So we are purely a specialist tax advisory business with 20 staff, soon to be 23 staff across the UK. We work generally with high net worth individuals, with entrepreneurs, family businesses, private companies, and importantly, a lot of the time it's with their advisors. It's with the likes of yourselves, and it's purely on a non-compete basis for the tax element. That's what we do, and that's what we stick to. Clients are UK and overseas, but we deal just with the UK side of the tax. There's a whole list there of our expertise and the areas in which we work, in addition clearly to property. I don't really wish to go through all those. Please read it. Please look at the website. Great pleasure to introduce my colleagues. These guys are the experts in property. So Robert Wilson and Rohan Manro, and they'll be taking you through various elements of what needs to be considered by landlords, property investors, and their advisors. What we're going to cover today, we'll start off, I'm going to give a brief overview of the current issues that are faced by property investors. And then within that, the boys are going to talk about the ongoing taxation of the income, mortgage interest relief and the restrictions thereof, capital gains tax on the sale, the reliefs that are available within the SDLT regime. Quite importantly as well, and often linked to portfolios, is the inheritance tax element. And clearly, within all of these discussions, looking at solutions available for the above. So let's start with a quick review of the property sector. At this point, you're all on mute, but potentially there's some pantomime like boos and hisses. George Gideon Oliver Osborne, Chancellor from 2010 to 2016. I think it's fair to say that Mr. Osborne had the property sector in his sight from an early start as Chancellor. Probably began with the Let Property campaign, which started back in 2013, aimed at collecting much more taxation that hadn't been declared on rental incomes and on the undeclared capital gains tax. This campaign started in 2013 and was meant to run, I think, 3 to 4 years. It is still running. So clearly there is an ongoing opinion that there's a lot of revenue to be gained from this sector. Let's just kind of chart what's happened, and it literally is charting the pain for property investors. So I'm not going to read through all of these, but I guess there's been some all of them probably pretty significant, but we're looking back to 2016 when the SDLT surcharges came in. April 17, mortgage interest relief restrictions started. So that was quite a pain point and became worse as the years went on. Also in April 17, the inheritance tax changes for the non-DOMs, where they've got UK residential properties, had quite a significant impact. And then April 2020, the 30-day reporting on CGT, which is still, a lot of people are failing this. And then this year, another 2% SDLT. So all in all, I think we can agree this is a sector that's been hit pretty hard. The issues facing the property owners, as you can read, so it's taxation of the rental profits, mortgage interest costs, and what can be deducted has got less and less for personally held portfolios. The capital gains tax, a lot of the reasons that people perhaps aren't looking at restructuring is just the fear of crystallising the gains. And also, I think we need to be aware that the OTS report last November talked of it was a big document discussing the CGT regime. Didn't come into effect at the budget. I'm not sat here with a crystal ball, but I think if I was a betting man, I would put decent money on it that there will be announcements regarding capital gains tax regime in the autumn statement. So kind of watch this space, start talking to your clients now would be our advice. SDLT, I think there is a lack of awareness of what reliefs are available, whether it's structuring or the growth of portfolios. And touching on the inheritance tax, all UK property is subject to IHT, so potentially planning can be done. Now, hopefully this kind of brings you up to speed with the landscape in the property sector, but actually I think there's one other thing that can often cause a roadblock to considering what can be done with portfolios. Often these are just the urban myths, the assumptions. I go on quite a lot of landlord forums and I cringe when I see what's spoken of. And when people approach etcTax, they're kind of coming to us, like they're probably coming to you guys, telling you what is fact, and often it isn't. So let's have a look. This one is probably the one that annoys me the most because I see professional advisors having put this. So you can transfer the assets, but you don't need to tell your lender. Horrendous. I've never seen a mortgage document yet that says you mustn't tell them of a change of ownership, whether it be beneficial or otherwise. And if you do tell your lender they're going to terminate the mortgage, no, not true. Go and talk to the lenders. You've got to have a minimum of 5 properties to incorporate. The boys are going to talk about that in detail. It is an assumption which is not necessarily accurate. Recently, I spoke to an advisor whose client had been told that they've got to run the partnership for 2 to 3 years minimum before they incorporate. No. And somebody said just recently, you need to do a minimum of 20 hours of activity for qualifying a business relief. I think the majority of landlords out there are absolute experts on the case law precedent set by the Elizabeth Ramsey trial, or case, should I say. Not necessarily true either. The other one, you can only get incorporation reliefs if you're going through an LLP. Nope. And there are absolutely no VAT claims. Let's not even consider it for residential property. We have in-house experts on VAT. We would always show every property portfolio consideration to them because there are quite rare occurrences where VAT can be claimed. So why not look at it and get the maximum? Mixed partnership protects your portfolio from IHT. That will be discussed later. That's my bit done. Hopefully it's brought up to speed with the landscape where we're at. I'm going to stop sharing, and it's a great pleasure that I can hand over to my colleague, Rohan. Thank you.
So just while you move across, we've got some questions that have come in. I just want to acknowledge that I've got Hitten, and then there's a few in the chat box as well. And Mark's just put it, if you can make sure the questions go in the Q&A box rather than the chat box, it just makes it easier for us not to miss them. So I'm going to acknowledge those questions at the start, but I know some of them are going to be covered in what Rohan and Rob are talking about now. So if they're not covered over in the content, then I'll make sure that we come back to them. So thank you already for the questions.
Thanks very much, Pete. Thanks very much, Simon. My name's Rohan. I'm an advisor here at etcTax. Work closely with Rob and Peter on the property side of things. Just bear with me whilst I get my screen to share. Can everyone see the slideshow?
Yes.
Yeah, brilliant. Okay. Right, so I'm going to be going through one of the sort of key issue areas, which is the taxation of rental profits. As Peter summarized on his chart of pain, there were a lot of changes that have taken place over the last 5, 6, 7 years. And it has changed the economics of buy-to-let businesses, particularly for those who are already involved in the space and have already built up a substantial portfolio. Those are the guys that are going to be hit the hardest. If you are just starting out, then as is always the case, start as you mean to go on and get the right structure in place from the very beginning. So what are the key tax issues from a rental profit side of things? Well, the first is the most obvious, the deductions to mortgage interest relief. and it's been dubbed a tax on turnover. Mortgage interest costs are quite often the largest expense in a property portfolio, and denying that that expense hits hard on the final tax bill. The second issue is that quite often property businesses are built up as a secondary source of income. These people will have jobs quite often in the higher rate tax bracket. And so where you've got rental profits and that surplus income isn't required, it's being taxed at the highest rates of income rather than perhaps being reinvested or being put into your back pocket. So what are the options around this? Well, again, there are going to be a multitude of options depending on the specific case. But the two sort of go-to ideas would be to look at, can I bring my family members involved? Can I transfer them a share of the rental income? Or alternatively, was quite a common strategy, but always more complicated than perhaps first meets the eye, is incorporating the property business and putting it through to a company. Now, whenever you are planning with property and you're looking at transferring ownerships or entitlement, there are going to be tax issues to address, and that includes stamp duty, land tax, and capital gains tax. And one of the key things here is that buy-to-let businesses are almost always going to be considered an investment business. And what that means is that you are not entitled to the same array of reliefs that are available for those who are operating your standard trading business. So, mortgage interest relief. The deductibility of these costs were restricted and phased in from 6th of April 2016. They took full effect from 6th of April 2020. And I've got an example on the next slide just to show what the difference is there. In essence, when calculating a person's tax liability or their rental profits, their taxable rental profits, you are not allowed to deduct the mortgage interest costs from the rental income. Instead, relief is given as a final cut off your bottom line tax figure. Now that's given either as 20% of the finance costs, so the mortgage interest costs, or if lower, 20% of the property business profits or the adjusted total income. So what this means is that basic rate taxpayers, generally speaking, aren't negatively impacted by this. Now, when looking at whether someone's a basic rate taxpayer, you need to take into account the fact that the taxable profit is enhanced by the fact that you're not allowed to claim an expense. So someone who would have been a basic rate taxpayer, after disallowing the expenses, may actually be pushed into the higher rate tax band. And so that's something to look out for. So here we've got a very basic example of what it is I'm explaining. So we've got John. He's got 16 residential properties, market value of 2 million and mortgages of 1.5 million. I'll use some fairly realistic proportions here. So 75% loan to value, generates a 6% yield, 125k gross rental income, and the mortgage interest costs of 45,000. So as you can see, in 2015, 2016, the taxable profit would have been 80,000. In 2020, 2021, the taxable profit is now 125,000 instead. Obviously, that doesn't take into account other expenditure, and I've just simplified it to illustrate the point. So what impact does this have? So the first point to note here is that in this particular example, the individual's total income has been taken up above the personal allowance threshold. So after 100,000, the personal allowance is tapered by £1 for every £2 of income above that. So personal allowance has disappeared. The second point to note is obviously you're being taxed on a higher amount of profit that does not actually exist. And so a large part of that is taxed at the 40% banding. Once you've got your tax figure, basic rate relief is given in that second column. So in this case, we've shown it as 20% of the mortgage interest costs. That's a deduction off his total tax bill. And then you've got the tax bill there at the bottom, which is 19,500 pre-introduction and 51,000 after it takes full effect. So what impact has that had? Well, in this case, the effective tax rate has shifted up from 24% to 64%, and that being the tax cost as a proportion of the actual profit realized. Now, 64% effective tax rate is just absurd, and as it demonstrates there, the profits take quite a chunky hit there. So what can be done? Well, as I mentioned, the first thing to think about is, can I get my spouse involved? If the spouse is a lower rate taxpayer in the basic rate band, make use of that banding. Now, one thing to be careful about when transferring property to a spouse is that if there are any mortgages on the property, what an individual is effectively doing is saying, I'll let you own some of this property, but you have to pay off some of the mortgage. Therefore, I've received a benefit in that I've released part of my obligation for paying that mortgage. That benefit is actually subject to stamp duty land tax. Now, that's quite commonly missed, or people are quite often unaware of that. So just something to be cautious of. One way of potentially planning for that is if you put in place a formal partnership. That can get around that charge. Another thing to be careful of is the settlements legislation. You can't simply give the spouse a share of the rental income without giving them a share of the underlying property. Once more, you can't do that. Generally speaking, you can't share it in disproportionately. So, you can't share the capital value 50-50 and the income, 100 and 0. Now, there are some exceptions to that, but that's the general rule. And ultimately, if individuals are continuing to grow the property business, are they quite simply kicking the can down the road? Eventually, perhaps the spouse will become a higher rate taxpayer and you're back to square one. But it certainly buys you some time, I guess. The other option could be to look to bring the children or grandchildren into the fold. Now, quite often, you're not going to want to give your minor children, a share of the income or entitlement to the property. There might be a concern that they go and fritter that away. So instead, you could look at setting up a trust. Now, there are various anti-avoidance provisions that prevent parents from setting up trusts and passing income to minor children. So that's generally not something that can be done. However, where it's grandchildren, then that is acceptable. Again, we've got the issue with the existing mortgages. If an individual is transferring property and they are receiving some benefit in that they're sharing the mortgage costs, there's potentially going to be a stamp duty land tax charge there. Again, that comes with the 3% surcharge as well. You've got the same issues around the settlements legislation, where you are transferring income to a third party, and you are in some sense still able to benefit from that income, then it might be attributed and taxable on you personally. Again, we've got capital gains tax issues here. We can't rely on the interspousal relief as we can above from setting up a spousal partnership or transferring property between spouses. Where a trust is set up, there is holdover relief that you can rely on. From an IHT perspective, again, if you are gifting to individuals, it's not an immediate event for IHT purposes. However, if you're setting up a trust, then subject to certain thresholds, you'll be paying an immediate charge of 20%. So that said, normally, but not always, the most sensible option is to look at operating via a company. Sometimes it might be a case of, right, let's bring the spouse in for, let's say, a year or two, see how our income levels stabilize, and then we can look at incorporating perhaps. A company structure is going to be more favorable if you are looking at growing the business. It's got lower rates of corporation tax. It allows you to reinvest more of the profits.
Rohan, just before you go on to the next slide, there's a couple of questions for clarity around the tax calculation that you showed on the slide before the last one, David and Simon. Simon's put, didn't understand the previous slide. The 9,000 tax relief comes off the total. It appears to be added on to the total. Is that right?
Oh, yep, that looks like a blunder from my perspective.
Perfect, and that's one of the wonders of this community, that whenever because we're talking to obviously qualified accountants that are working with it day in, day out, there's the opportunity to get clarity on these these things.
So the bill there is going to be 33,500 instead of 51,500. Still another 10,000 per annum there on top.
Yeah, so there's the effective rate still way over the 24%, but it's not the 64. It's a bit lower. Okay, brilliant. Yeah. Thanks for that. Thanks for that clarity, Rohan.
And one other point I would note just on this slide is that we've assumed that they have no other sources of income. So the basic rate bands are fully available. In most cases, that wouldn't be the case.
Yeah, brilliant. Thank you.
Right. So moving on. Incorporating a rental business, very, very popular strategy at the moment, not suitable for everyone. The issues to address when looking at transferring property to a company is that firstly, there will be a disposal for capital gains tax purposes, as there will be a transfer between connected parties, and so it's treated as a sale at market value, and you've got, potentially 28% charge on any outstanding capital gains, and importantly, without the funds available to pay it. Again, stamp duty land tax, the company is a connected person and will be acquiring the land, so it will be paying stamp duty land tax. That actually is more complicated than people might think. The SDLT legislation is notoriously badly drafted, and notoriously complicated. I'll go into that in a bit more detail. But to summarize, there's two fairly significant dry tax charges to deal with before you can think about actually getting through into a company. And one other point I should note is that the capital gains tax will be payable within 30 days of the transfer, and the stamp duty land tax within 14 days. So it's not as if you've got a period of time to generate these funds. So from a capital gains tax perspective, as I've said, you'll be crystallizing a charge there, as if you disposed of the property at market value. If you've got non-residential property, it's rates of 10 and 20%. If it's residential property, it's 18 and 20%. Going back to John's portfolio, let's assume he has a capital gain of 500k. If it's all commercial, that's a bill of 100k. If it's all residential, that's a bill of 140k. And if it's somewhere in between, if it's mixed property or a mixed portfolio, then it's somewhere in the middle of that. So stamp duty land tax. The starting position is that the company is deemed to have purchased the property at market value and pays SDLT accordingly. If you're transferring a number of properties, the transaction will be a linked transaction. So instead of paying SDLT on the individual properties, you'll be paying SDLT as if it was one single transaction. And the effect that has is that more of the consideration is taxed at the higher rates of stamp duty. On top of that, just to make matters worse, companies always pay the 3% surcharge when acquiring residential property. And if there is any residential property that is let to connected parties, or isn't being let on a commercial basis, then you potentially have what we call the super rate of 15%. So that's just a flat rate of 15% on that property. And you also need to take into account things like the annual tax on envelope dwellings, or ATED for short. Here's just a quick computation. So we've got the portfolio of 2 million, and the rates that apply. Those are the rates including the surcharge. This has been calculated on the basis that the linked transaction rules apply, and so it's a single transaction worth 2 million, and you've got stamp duty, land tax to pay at the end of that of 151k. So we've got a CGT charge of potentially 140k, SDLT of 151k, all payable within 30 days. Incorporation doesn't look particularly appetizing. Now, what can we do to plan for those charges? Well, from a capital gains tax perspective, the only real option is going to be incorporation relief. From a stamp duty land tax perspective, there are a number of options. If the transfer is from a partnership, then you can rely on the partnership provisions, which are, again, notoriously complicated, but broadly, provided that the company is connected with the partners, there's no SDLT charge, and HMRC accept that as being the case. If the sort of golden solution of there being a partnership isn't available, then we can look at multiple dwellings relief, which essentially reverses the linked transaction rule. So you go back to paying SDLT on the average cost, and so you spread the consideration across the lower bandings. If you're transferring 6 or more dwellings, then you can rely on the non-residential rates of SDLT, and that also means that there's no 3% surcharge to pay. Quite often it's a case of weighing up multiple dwellings relief versus the 6 or more dwellings rule. And finally, if any of the properties are mixed use, or as part of the transaction there is a commercial property, then that paints the entire transaction as being non-residential. Now, that's generally understood to be the case by most practitioners. HMRC may query and question some of those points, particularly where it's just a case of, I have 10 residential properties and 1 commercial property. HMRC might not like that you rely on the commercial rates, but in the legislation, the way it's worded, that's how it applies. I should say that's in our view, at least, anyway. So from the capital gains tax perspective and incorporation relief, the key requirement is that there is a business, a property business. Now, it's not defined. HMRC used to give clearance, and they no longer do. And so it's a bit of a grey area, and it's always worth taking advice from someone who's looked at the case law on this. The leading authority is the other Ramsey case, not the avoidance Ramsey case, but the incorporation relief Ramsey case. It sets out a list of facts that were considered, and to be quite honest, a lot of those facts are what you would expect from a property investor in terms of the activity involved. The case then actually referred to a number of VAT principles when looking at whether or not there's a business. And the key criteria are, is it a serious undertaking? Is it continued or pursued with reasonable continuity? Does it have some longevity? Is there substance in the business in terms of the amount of turnover that it's producing? Is the business being conducted on recognized business principles? And are the activities of a kind that are commonly made by people who would seek to profit by them? Now, like I say, these were considered in the context of VAT law, but have been applied here. And I suppose ultimately what you're looking for, the key distinction is there an active business, or is this a passive investment? Now, you might have Janet down the road, who owns 3 properties. She built them up with the idea of supplementing her income in retirement. She's not particularly fussed about, growing the portfolio, maximizing the rental yield, or making use of, refinancing deals and whatnot. She is unlikely to qualify for incorporation relief. Whereas on the other hand, you might have Jane at the other side of the road, who's got 10 properties, regularly refinancing any equity, reinvesting that equity, having a strategy in place to buy perhaps derelict property and refurbishing it, something that has a bit more substance and an activity involved, and that makes it look like a commercial venture. As a rule of thumb, I suppose what we look for as a minimum, but it's not necessarily absolute, 5 or more properties, turnover at least 20 to 30k, at least around 10 hours per week. Looking at the type of properties that have been acquired can help indicate whether or not there's a business. For example, if you've got HMOs or student or professional lets, where you're renting out individual rooms as opposed to the property as a whole, that would indicate that more activity is required than, say, a long-term family let, where the same family's been in there for 10, 15, 20 years. Other factors to take into account when looking at whether there's a business and commercial principles are being applied: is there a business name? Is there a business bank account? Do they produce management accounts? Do they regularly undertake renovation or refurb work? Is there any particular strategy? Do they provide any additional services? That type of thing. So, moving on to stamp duty land tax, where the assets are transferred from a partnership to a company, specific provisions apply. And in essence, if the partners are connected with each other and connected with the company, you're more or less in the clear. Now, there's a lot of exceptions to that, but that's the general rule. If the partners are unconnected, unfortunately, one of them will not be connected with the company, and there will be an SDLT charge. Now, that can be planned for where you can establish that those unconnected individuals are acting together to control the company. Now, generally speaking, if the decision to incorporate the business should satisfy that, but I don't think you'd want to rely on that alone. I think what you'd want to do is perhaps look at having a shareholders agreement in place, just to evidence that. Again, just by way of caution, the partnership rules are notoriously complicated, and it's not just simply a case of if there's a partnership, then the exemption is available. Some of the commercial issues to consider when transferring to a company. You'll need to look at moving the mortgages across. Now, lenders may take this as an opportunity to renegotiate terms. In my experience, most lenders are happy to give you fairly standard rates, if not favorable rates, particularly where you're moving a number of properties across at once. One thing you will need to think about is whether, if you're in any fixed term deals, whether there will be any early redemption mortgage penalties. Lenders might be willing to waive those. Otherwise, it might be a case of just waiting for your deals to mature. There will be a change of landlord. So you need to think about the legalities that come with that, notifying tenants, looking at the tenancy deposit protection scheme, tenancy agreements, supplier agreements, and the like. And finally, you'll need to consider whether individuals are familiar with the nature and concept of a company. A company is a separate entity, and we've come across cases where clients just consider the company and the individual to be one and the same. And the issue that has is it often becomes quite difficult to follow the bank account trail of what's happened to cash. And that can create all sorts of issues around reporting and preparing the accounts. Now, generally speaking, lenders must be informed, and we would almost always advise that. We can't advise on mortgage terms and conditions. We are aware that there are people in the space who suggest that lenders don't need to be informed. Ultimately, it's going to be a case of let's take some legal advice and see what needs to be done. Our view is that the more transparent you are, the less risk there is, and the better off you will be. Right, that is my section.
Just okay, brilliant, Warren. Thank you. And I've got lots of questions that have come up as a result of your as a result of the presentation, and I know Rob's in the background bursting to get on with it. So I'll just run down a few, and if there's some simple, quick answers that you can give. I know some of these are probably going to be a bit more complicated. But Simon, will the mortgage lender let you incorporate? I think Rohan's answered that. If not, Simon, can you post a different question? Hirsch has asked, if one transfers property to a spouse in a limited company by giving her shares, is that subject to land duty tax?
As a general principle, no. If it's part of a wider arrangement whereby property is transferred to a company and then the shares are transferred, then potentially yes.
Okay, thank you. And then if one landlord for several properties, why is that not a business? Well, we've gone through that and discussed that. Will a limited company investing in properties be taxed at 25% going forward?
So that's something that's to be seen. On the face of it, yes. Again, it's subject to the thresholds. There are rumours that 25% rate was simply announced so that when it comes to the election, it can be taken away again and used as a voting tool. So we'll see what happens there. But on the face of it, but yeah, potentially.
Brilliant, thank you. And I'm in that camp as well. May I ask, what is the Incorporation Relief?
So the way Incorporation Relief works is that the capital gain that would otherwise crystallize is instead deferred, and that deferral is achieved by rolling the capital gain into the base cost of the shares, so that if you then at some point in the future sell the shares, they will have a lower base cost than originally would have been the case, and so you're recrystallizing that capital gain.
Thank you. And then Rob's asked, and this is where my technical knowledge fails me, so I'm going to read it out and hope it's not rude or anything like that. But is the ATED, spelled ATED, value of 500k per property or the portfolio?
No, it's per property.
That's per property. I'm pleased you understood that.
you look at ATED on a per property basis and pay the charge on a per property basis.
Thank you. And then Deborah's asked, in what circumstances can joint owners elect to have rental income 100% taxed on one owner only?
So there is a form that you can complete. The name of the form, I can't recall the name of the form, but where you've got joint tenancy between husband and wife, then you can submit a form to HMRC to change the income sharing rights.
Brilliant, thank you. And Hitton's just typed in their form 17, so that'll be Michelle 74. So that's what the form is. Brilliant. Can a deed of trust be used to give beneficial ownership to a limited company and keep the mortgage in the personal name?
So, in theory, yes. Now, you'd obviously need to think about whether you're breaching the terms and conditions of your mortgages.
Thank you.
I would add that where there are no mortgages, using a deed of trust could be quite an easy way to incorporate without the hassle of having to go through the conveyancing process as well.
Okay. And then there's another sort of subsequent question. Are you able to license the property to your limited company and have the limited company manage / let the property rather than actually transferring ownership to the limited company?
Yeah, so you could enter into some sort of management agreement with the limited company. It's quite a common piece of planning. The only caveat to that is that everything should take place on arm's length terms. So you're not going to be in a position where you're transferring, 90 or 100% of the rental profits. Realistically, it's going to be around 10 or 15%.
Thank you. And then Hitton, I've got your original question at the beginning. I think that might be a bit too detailed for today, but we'll see if we've got time at the end. And Kalpesh, I can add yours at the end as well. And then a Manaf has asked, a client has a property bought approximately 10 years ago for 50k. The value is now 450k. He has his niece living in the property who pays very little rent. The client wants to gift the property to his niece. I assume you'll be hit with CGT. Is there a way to minimize it?
Yeah, so I think there would be. We need to look at all of the reasons why he wants to give it away and what the niece will do with it, whether she'll continue to live in it. But my initial thoughts would be that you could set up a trust for the child, for the niece, and that would enable you to obtain CGT relief. And then at some point in the future, when you're ready to hand over the property, that trust could be unwound, the property transferred to the child, again with relief on the way out. Now, there are certain thresholds, because there will be an IHT charge to take into account, where you're transferring value of more than 325k. But if it can be a husband and wife transfer, then you've got a threshold of 650k instead. So that could be an option.
So there's lots of ways around that if necessary. Brilliant. And I'll save the Hitton and the Kelpesh one until later, because I know Rob's in the background raring to go. So let's bring him out.
Thanks, Simon. Thanks, Rohan. It's a bit like Doctor Who, this, when one face phases out, another face phases in. I've got a bit of a tough task, I'll be honest, because my capital gains tax discussion could be viewed a bit doom and gloom, but we'll do our best, so please bear with me. Let's just get the slides up. Here we go. Just bear with me. Right, I'm guessing you can see that, Simon.
Yeah, we've got those, yeah.
Yeah, marvellous. Right. Okay, so Rohan's just talked you through options, effectively, in relation to taxation of property income. I'm just going to touch now on capital gains tax, which I'm sure most people will have been aware was an incredibly hot topic in the run-up to the election. So just briefly on that, one of the questions pre-presentation was, where are we now? And I wish I could tell you that, because if I could tell you that, I could tell you who won the Grand National in advance as well. I'll be sat on a beach somewhere. But it was clearly widely touted that the CGT rates would be going up in effectively the last budget. That didn't happen. Broadly speaking, CGT is always lagging significantly behind income tax, really just because CGT is only a tax which is paid on a disposal of an asset, which happens far less frequently than obviously a monthly or weekly or whatever income you might be receiving. So one of the suggestions was, are CGT rates going to be aligned with income tax rates? That's obviously not happened, but just sort of put in that first bullet point there, the second OTS review. Now, for those who don't know, the OTS stands for the Office of Tax Simplification, which is probably the biggest contradiction in terms going, really. Just a bit of background, the way that the OTS works is they will receive some input from Parliament, basically, and likewise Parliament will receive some input from the likes of the G7, lobbying groups, those sorts of things, really, as to whether or not there is a required change in tax policy. That gets passed to the OTS. The OTS come up with some recommendations. The OTS thereafter send those recommendations and proposals out to relevant industry bodies, ICAW, ACCA, you name it, those sorts of guys. The industry bodies are then allowed, if you like, to actually provide their own commentary on those proposals and provide their sort of input, so boots on the ground input as to whether or not those proposals are suitable or not. What happens is the industry bodies say, this is an absolute load of rubbish. Why are you doing this? It's a complete waste of time. The OTS take that away and come back and say, thanks for your suggestions. We've completely ignored them. We're going ahead anyway. But there is a review process in progress, effectively. We've already had the first review, which is where the sort of announcement, if you like, that CGT rates might be going up. The second review has been concluded, and we are awaiting a sort of final piece off the back of that, and it's been touted that it's going to be released in spring of 2021. So it doesn't really give us a huge amount of time between sort of now and then as to what that's going to be, but effectively, I would say over the next couple of months we should be a lot clearer as to what's actually going to happen, and thereafter, of course, we can start talking to clients and make sure they are aware of those situations. A few more sort of changes to CGTs, you're probably aware as well. Principal Private Residence Relief used to always get the last 18 months of ownership as a tax-free disposal. That's now gone down to 9 months. I said there no more letting relief. It's not strictly true, because you still get an element of letting relief where you're actually living in a property and renting out a room in that property. But the more sort of widely beneficial letting relief, when you actually move out of the property physically, is no longer available. CGT on the sale of a second property, it's not your own home, now payable within 30 days, and actually return does need to go into HMRC and tax paid within that 30-day period. Annual exemption, again, you're probably aware, frozen until April 2026. Possibly not going to create the worst effect in the world, but certainly something to bear in mind. So clients are losing that sort of extra couple £100 each year tax-free. The biggest changes, though, and one of the pre-questions was, I believe, somebody's got a Dutch client who owns a UK residential property. Now, HMRC and the government do not like non-resident landlords owning UK property. Clearly, there is much debate as to the availability of affordable housing for people trying to get on the property market, and it's considered to be a bit unfair where you've got a non-resident individual with a big stash of money that's able just to plough that into the UK property market, regardless of obviously the jobs it creates at the other end. But in light of that, there have been a huge swathe of changes in relation to CGT in respect of non-resident landlords, and by non-resident landlords we mean individuals and companies and trusts as well. Just sort of briefly touching on those. First sort of earmark, if you like, was from April 2015, a non-resident landlord selling a UK residential property would be subject to capital gains tax on the uplift in value from April 2015 to the point of sale. What HMRC were expecting, and clearly it's incredibly practical, is that everybody in that position was going to rush out and get their properties revalued at the April 2015 value, which clearly hasn't happened. But as a default rule, HMRC would expect the capital gains tax computation for those affected clients to include an April 2015 value. That is the default position. The other two ways that you can work out the CGT on that basis, and you have to actually elect to actually apply these two computations. You can effectively, the first one, you just take an apportionment of the total gain from April 2015 to the point of sale. So you effectively ignore, say, property was purchased in 2005. We ignore the gain that's arisen, if you like, from 2005 to 2015, and we just take the few years after 2015 to the point of sale. So that's normally, if that works out better than the default rule of rebasing to 2015, then the taxpayer is perfectly entitled to use that. The other method is you basically just work out the gain and you don't rebase it. You don't consider April 2015 at all. That would obviously only be beneficial to a client, though, if they are expecting sort of a fairly significant loss on the property, and that sort of effectively crystallises that loss. Because clearly, if there's been a sort of an uplifting gain since 2015, then that loss could almost sort of be lost to a certain extent. We then move on to talking about April 2019. Effectively, April 2015 was in relation to residential property. April 2019 now is in relation to commercial property also. The same rules apply for a sale. Default position, you rebase the value to April 2019 and then work out the gain based on that. But the other two calculations are possible as well if the taxpayer wishes to elect for that. Further, in April 2019, non-resident companies are now subject to corporation tax on property profits also. And again, we're looking at sort of a rebase in 2019 also. It was incredibly popular to circumvent any charge to UK tax for a non-resident landlord to set up a non-resident company, buy the property through that company, and effectively the profits, the gain, and also the inheritance tax were fully outside of the scope of UK tax. That's all clearly now changed, and therefore we are seeing an awful lot of situations where clients have set up these structures, paying exorbitant fees effectively to keep those structures going, and they provide them with absolutely no benefit whatsoever. Last sort of point just to make on this, it's a bit of a weird point. If you've got a client who is a shareholder in what we would class as a property-rich company, and the shareholder is also non-resident, if they were to sell their shares in that company, theoretically, because it's a non-UK asset, it escapes the net of UK capital gains tax. But where the value, if you like, of that company is 75% or more made up of UK property assets, HMRC can effectively just look through that and tax them to capital gains tax in the sort of the usual way in the UK. And thereafter, just a bit of a summary of the CGT rates. Are they going to go up? It's probably likely that they will. But it's just sort of something to summarise and bear in mind that non-resident clients are certainly subject to UK CGT on disposal of property and also holdings in sort of property-based structures also. But clearly, the method of calculation and trying to work out what's the right tax to pay can be a bit complicated. So if you're unsure of it, then please do seek some advice on that. So with the advent of changes to capital gains tax in mind, just to put a slide there, it's more than likely going to be a case of when and not if. As I say, we don't know what the rates are going to be, but I think it would be safe to say that they will certainly go up in one way, shape or form. It's generally quite challenging to plan effectively for capital gains tax when we are talking about property, because largely speaking, whatever you do, you are actually making a disposal of that property and therefore crystallising the charge. Now, Rohan just talked briefly about Incorporation Relief. It is a relief available, but it's a relief available in fairly limited circumstances. There is also potentially holdover relief available if you were to transfer a property into a trust vehicle. But again, depending on the facts and the individual circumstances of the client, is that going to be a suitable option for them? So some ways that sort of clients have been sort of thinking about this is, we were planning always to sell the property. It was just really a question of when effectively, but now potentially in light of changes that are afoot, do we just sort of put the property on the market now? Let's just sell it, we'll suffer the tax charge, but thereafter, what's left over, we're keeping a larger sort of net amount than we might do if we were to wait another sort of year to 18 months or so. But clearly, of course, selling a property can take anywhere from sort of a few months to a few years. So not always the most sort of practical. Put down there as well, friendly sales. By friendly sales, I don't mean sort of asking your mate to give you some cash. What I mean by that is it possible, for example, for a client to sell a property into a company if the company is already existent, it's got built up cash reserves? Those cash reserves could be used to pay off the capital gains tax liability. The other option would be to sell the property to the company in exchange for a director's loan account. Now, clearly with that, particularly with the advent of the 30-day filing position now for sales of properties and the payments of the tax, there is going to be a cash flow issue there, and that does need to be borne in mind. SCIS and EIS reinvestments are always still available. It's a very sort of mixed bag, as you may know if you've dealt with that sort of type of investment. Some are very, very good and do work, others not so. But again, with any kind of reinvestment, SCIS or EIS, yes, you are allowed to sort of effectively defer the gain that's payable until the time that you're able to suffer it effectively. But you are losing the benefit of that cash. You are required to invest the proceeds of the sale into that structure. And of course, there is a risk there that structure would fail and you'd potentially sort of lose out on everything. So sometimes good, but not for everybody. I think it's probably the way to say for that. Interestingly, part of the OTS review is also challenging the idea of, at present, if I were to pass away tomorrow, my assets would be uplifted to their market value in my estate, and thereafter, if they are distributed to my beneficiaries, they would receive those assets at their market value. So if they were to then sell it a day later, their capital gains tax exposure would be pretty limited. One of the OTS recommendations at present is we actually remove that element of it in relation to property and potentially also other assets as well. So on the person's death, the CGT base cost is still their own base cost, if you like. And actually that does then cause some complications for where those assets are distributed to, and can cause all sorts of unwanted and probably sort of uncontemplated sort of aspects of that. Again, unfortunately, we haven't got the full details of that, so we have to just sort of keep our ears to the ground with that. With that in mind, though, is there an element of maybe we were always going to leave the asset to a child or children, so do we gift that asset now? As Rohan discussed as well, gifting an asset to anybody other than a spouse does cause capital gains tax issues. Again, sort of relates to cash flow as well. And as well as Rohan discussed, if there is a mortgage on the property, then that can cause some SDLT issues, certainly there as well. Rohan's talked about incorporation. One point that Rohan didn't mention, which is not deliberate on Rohan's part, On the incorporation of a property portfolio, the way, if you like, that the accounting treatments and the Incorporation Relief works, the company is treated as purchasing, in effect, the properties at their market value at the point of incorporation. So on the balance sheet, you will record the properties at their market value, and therefore, if you bought the properties for, say, 500,000 and the market value now at incorporation is 1 million, the company will have those assets on its balance sheet valued at 1 million. So if thereafter the company sells a property, the gains and the resulting sort of corporation tax liability should be only limited to the uplift in value from incorporation to the point of sale. So effectively, you've washed out the gains when you've actually incorporated the portfolio, which is quite a useful idea. But clearly, property's now been sold. We've got cash in the company. If the client wanted access to that cash, he's going to have to take it out, and he's going to potentially still pay income tax on that. So again, just something to bear in mind. Again, something that Rohan touched on slightly, it is possible to convert a joint tenancy into a tenancy in common, for example, and effectively sort of carve out different percentile interests in a property and make sort of regular gifts of those sort of small percentiles on an annual basis. So the client will be using up their annual exemption for capital gains tax purposes. The actual sort of value of the gift is sort of fairly limited from an inheritance tax perspective also. So that's a way effectively a client can drip feed out different portions of a property to their children over a number of tax years and make best use of allowances. Notoriously difficult to get right in practice because clearly, obviously, you're trying to sort of value the property and then value the percentage of that property. But it is certainly possible. Just one thing to bear in mind, GWROB stands for Gift with Reservation of Benefit. Effectively, without going into a huge amount of detail, if a client is gifting an asset to a third party, be that a family member, be that somebody else, but they are still able to benefit from that asset, in this case, a property. So, for example, if they are still living in the property or they are still receiving rents from that property, potentially that gift has actually failed from an inheritance tax perspective. So it can be structured in such a way that it's not. But again, it's just something to bear in mind. Now, that's just a bit of an overview. Is there any sort of further structuring available?
Rob, that's okay. Just because I'm conscious we've got 2 minutes until 11
yes,
o'clock. Yeah, and obviously lots of people will be disappearing 11 o'clock to go and put these ideas into practice, maybe. Yeah. But if anybody's got any questions, Rob, or any cases that they would like you to look at, what's the best way for them to make contact?
Yeah, so the best way is we'll provide you with Peter's contact details, because Peter sort of acts as a bit of a linchpin in the business for sort of filtering through inquiries and leads in that manner. I mean, Rohan and I are always available to answer queries, but we've also got other sort of work that we need to be getting on with at any one moment in time. We've got a team of 20, so there will be somebody in the business at any one moment who can answer that question. So the best thing to do for people is simply just to either pick up the phone or drop Peter an email. And Peter will ensure that query is passed to the appropriate person, and they can pick up the phone and speak to you guys thereafter.
Brilliant, excellent, thank you. And Mark has popped the email address into the chat box, Peter's email address into the chat box. And I also believe on the website you said earlier that there were some resources that people could look at.
Yeah. So what we've done in sort of recent months, effectively, is we've got an awful lot of kind of writings, articles, interesting pieces spread around. Effectively, what we've done though is effectively formed a link to a contents page, for want of a better description. So details breaks down IHT on property, CGT on property, you name it, it's all there. So there's a bit of blurb, and then you can actually click on further links, which take you through to hopefully an interesting, thought-provoking piece, which should sort of answer some queries for that.
Brilliant. And so we've just turned 11 o'clock, and so we're gonna call it a day. Rohan has been doing an excellent job in the chat box whilst you've been talking, answering some specific questions. So if anybody's got, I'll leave the webinar running at the end. But if anybody's got any questions or they see the questions through, if you click on the answered box on the Q&A box, you can see Rohan's answers to that. But just to finish off, Lewis has popped one in. Around CGT on commercial property. If the client has sold the commercial property for 1.4 million, but financed the purchaser for a mortgage on the 1 million so has only taken 400,000 on the purchase date, is there a way to defer the CGT payment on the sale of the original disposal?
I think the default position would probably be no, but in terms of the actual sort of mechanics, if you like, of how the transaction's been structured, what we'd probably be looking there in that case is probably some sort of argument there's a deferred completion, effectively. So we're just sort of advancing the completion date until the finance has all been sort of sorted out to your client's end. So potentially possible. We might actually be able to sort of retrospectively sort of put that in place also, given obviously the fact pattern that the client's got in that circumstance.
Brilliant. Excellent. Thank you. So the default position is no, but there is potential to do that. And Manaf has just asked whether the slides will be available. So we will definitely send out the recording. Is it possible for us to send out the slides as well, Robert?
Absolutely, yeah. Because I mean, there's a couple of interesting points. Just on a few questions coming up about SDLT. So there's a few sort of they should actually be fairly easy to understand on that as well. So by all means, that just sort of finishes off the last little bit I was going to come on to.
Brilliant. Excellent, Robert. Thank you. And as I've said, the email address for Peter is in the chat box. If you've got any specific questions that you would like some support on from etcTax, that's great. I know Rohan, I can see on the Q&A box, he's typing away furiously answering Hitton's questions. So I will leave him to do that. I don't know whether you're still in the background, Peter, or not, whether you're welcome, Manaf. Brilliant. So that just leaves me to brilliant. Hello, Peter. It's fascinating, isn't it? I know. And hello, Rowan, you're back again there. The knowledge, the tax knowledge, and the ability of people like you to answer questions like that. You're just. I find it staggering how big your brains must be to hold all that knowledge. And I didn't even know there was one Ramsey case, let alone two Ramsey cases. So that's just far out of touch I am. So just leaves me to say thank you very much to the community, as always, for the questions that you've asked during the course of the morning. As I always say, the questions that you ask make these situations, these conversations unique, and they are always welcome. And then just finally to say thank you to Warren, Robert and Peter for coming along this morning and sharing your expertise on what is such a popular and for me appears to be a very complicated property tax area. And I have discovered that I don't own a property business, so I won't be able to incorporate my one as well. However I massage my situation, it's not going to fit into any of those requirements. So brilliant. Thank you very much for coming along, and I will see you all again soon. Brilliant. Thank you. Bye bye.
Everybody. Cheers.
Thank you.
What a session that was with Peter, Rohan and Robert from etcTax. They shared so much information in that hour. As always, if you've got any questions or comments, please post them below this video and we will gladly answer them. Please remember to hit the like button and subscribe to the channel so you get notified the next time we upload a video for you. On the bottom of your screen now, down here again somewhere, you should see two videos that we recommend you watch next.